Financial structure of a firm is the way the assets and operations are being financed. It can have a strong influence on the risk and value of the associated business. So a company employs various modes of financing to acquire assets and to support its operation. And the financial managers are the ones that deals with the responsibilities of deciding the right mixture of equity and debt to optimize the financial structure. The financial structure is composed of short-term liabilities, long-term debt, and shareholders' equity. It is different from capital structure because capital structure only includes long-term debt and shareholders' equity, and it ignores short-term liabilities. That's why most of the successful companies focus more on the financial structure rather than the capital structure because, as I mentioned earlier, the analysis of financial structure reveals both the short term and long term aspects of the company in terms of profitability and stability, whereas capital structures that only focus on the long term stability of the company. Short-term liabilities include but are not limited to accounts payable, accrued liabilities, and short-term loans. The financial structure is affected by various elements such as market competition, utilization of assets, behavior, and decision of managers, as well as the level of sales. That's why financial structure of a company is important for the management and shareholders because it defines various modes of financing that the company uses to support its operation. The liquidity ratios of a business indicates the ability of a firm to meet short-term obligations. These ratios depends on the short-term borrowings or liabilities of the company. The liquidity ratio also indicate the current stability of the firm, and the level of working capital of a company also affect the profitability of the company. But the existence and stability of companies depends on the profitability, as it would be illogical for a company to operate for an extended period without making any profit. That's why the profitability of a company is dependent on the financial structure, as a company would not be able to operate without finances, and it would have nothing to offer or sell to its customer. A company that depends on debt could have high return on investment, but having a financial structure with more debt could prove risky if a company is unable to honor its obligations. A firm that is either oligopoly or monopoly may easily support a financial structure with more debt because one can easily forecast its sales and cash flows. The financial structure of a company gives an idea about the leverage and cost of capital, but for startups, a financial composition may not matter much than a mature company. A new company gives more focus on the funds rather than the source of funds. However, a long-term survival of a company depends a great deal on having an optimal financial composition.